Hey guys, Marcel here. I'm joined by my colleague Emerson Savage. Emerson is institutional portfolio manager with Lewisburg and works out of the Halifax office, which we're in here, which is fantastic. Actually, it looks great.
Yeah, it turned out pretty nicely. So we've been here for close to a year now. We're pretty lucky that we get to walk in and see a nice view of the Bedford Basin every day. So we're pretty thankful for that.
And Theo's there too, so
Yes,
that's nice.
Yes, that's right.
So Emerson and I have been kind of circling this conversation around the 60-40 portfolio. Its merits. It's been in the financial media quite a bit lately. So let's start with what is the 60-40 portfolio and why has it been so important to investors over the past several decades?
Sure. I would say that the 60-40 portfolio is probably the most commonly used allocation as far as investment risk among investors globally. And what it is a 60% allocation to equities or stocks and a 40% allocation to bonds or fixed income or your kind of safer assets, more generally speaking. And it's made up for investors, generally speaking, what constitutes a balanced risk profile, somewhere in the middle.
It's a starting point for most investors to get,
if you've got a moderate willingness and ability to take on investment risk, this is typically the type of portfolio you would have ended up in, historically speaking.
Yeah, for sure.
And this portfolio, and just not go too in depth into it, but one of the key reasons that it's constructed this way is that bonds have a negative correlation to stocks.
Yeah.
So when stocks go up, very generally speaking, bonds tend to go down or be stable. And in times of crisis, when equities do poorly, bonds tend to perform much better.
In normal markets.
Yes, of course.
Of course.
So that factor makes for a much more stable and much more stable ride, generally speaking, for investors, and it generally reduces portfolio volatility.
Yeah, it smooths out the ride.
Yeah, that's exactly right. So, and I would say as well, it's not just been used by private clients. This 60-40 mix is really commonly used in the institutional world as well, among nonprofits like foundations and endowments, and more perpetually oriented pension plans like multi-employer plans and government plans. Yeah,
and it's served them well for a very long period of time. It has delivered exactly what it promised. So now, why are some now questioning the 60-40 or the traditional balanced portfolio's usefulness as a benchmark or as a portfolio strategy going forward?
Absolutely, yeah. We're seeing it constantly, right? It's one of the more common kind of headlines we're seeing in writing in the financial world. It's the death of the 60-40 portfolio, and what does that mean? Well, this portfolio has historically returned, very nice returns for investors as equity markets have returned, very strong, 10 to 12% returns historically, and bonds have, given very nice performance as well.
And it's been good on a risk-adjusted basis too. So risk-adjusted returns, the returns you would get for the risk taken, I think it fared well in that space too, right?
No
Not
question.
in absolute, but in relative,
So the kind of the key one to look at, or the key piece of the 60-40 that's really changed over recent years is the bond side. So the 40% allocation to fixed income. And the environment there has changed completely. So if we look at, very simply, the Government of Canada 10-year yield, we look at that in the 80s, it was as high as 17%. So you could lend to the Government of Canada, which is
barely no risk, basically no risk,
If there's risk, there's no credit risk. You're lending to a established sovereign government that can print its own money, realistically speaking. So it's considered the risk-free rate.
It'd be the lowest yield you'd expect in whatever environment you're in.
Yeah, that's exactly right. So you could park, X dollars there back in the 80s and get a really, really nice return. If we look at the 90s, though, as we've moved on, that yield had gone down to the 5 to 10% range. And if we go to today, that yield has fallen very significantly over time, but even more so in the COVID-19 era as monetary policy and central banks have driven rates down even further. So the current 10-year Government of Canada yield is 0.6%.
So from 17 to next to zero.
It's exactly right. So a very stark contrast compared to what it used to be. And the other side of the spectrum is important too. Equities, I would say the most common thing we're hearing there from folks is equity valuations are stretched. The price earnings multiples or CAPE ratios on equities, generally speaking, have increased.
A lot of those markers that people use to measure the market.
That's right. It's just generally speaking in most developed equity markets, valuations are higher than they were in recent years. So But what that means, generally speaking, for an investor investing in equities, if your valuations are higher, historically, that's meant that your going forward returns would be lower.
That's right.
So you're looking at both sides of your 60 portfolio being potentially challenged going forward. Certainly the bond side, as you're more likely to achieve that yield or something very close to it. But the equity side is potentially challenged as well.
Sure. So I mean, bottom line, does a 60-40 portfolio still have a place in institutional and private wealth portfolios?
I think it does, and I think the conversation around 60-40 might have a little bit more nuance than it would have in the past.
Okay.
That said, one of the key tenets of the 60 portfolio and why it's important is that negative correlation between stocks and bonds.
Right.
For example, if we look at flights to quality or crisis times in the market when equities perform very poorly, that government of Canada bond, for example, or bonds generally speaking, tend to perform much better.
Sure.
And that's what we did see earlier this year during the difficulty in March.
Mm-hmm.
So that negative correlation is still very important, and it reduces the total portfolio risk for investors that are invested in equities and
quite
bonds.
a bit too.
And it really has a substantial impact, and that negative correlation has still been, even though bond yields have fallen down, that negative correlation has still generally been in place. In Canadian or in fixed income and equities, that relationship has still been there.
Yeah.
So you're still getting that benefit.
Yeah.
That being said, I think it's very important to add some nuance there, and I think a 60-40 portfolio, and I think Canadian investors generally do have what we call home country bias.
Yeah.
If we talk about the percentage of the global market cap that Canadian equities make up, for example, it's not that high of a percentage, but we often see Canadian investors with 70-80% of their allocation within Canada.
So hyper concentration,
very
and
concentrated.
Lots of data to back this up too.
Absolutely, it's very, and not just in the in the private wealth context. We do see it in the institutional world as well. And what that's historically done, I mean, that has worked okay over time, but the Canadian stock market is very concentrated itself. High allocations to financials, high allocations to materials, and with the oil price where it is, the allocation to energy is a little bit lower, but historically it's been very high. So you're allocated to basically three sectors.
Yeah.
So that's what I would say there, the takeaway, and to consider in the 60-40 context is, don't just diversify away from the 60-40, don't diversify away from it, diversify within it.
Yeah.
So what I think that means is don't have too much home country bias, and there are economic reasons to go overweight Canadian equity that we won't necessarily cover today, but think about global diversification.
Yeah.
Think about U.S. and global equities and potentially even emerging markets, because even though equity markets, generally speaking, do have relatively high correlation to each other, there is still a diversification benefit of having those. And if you look at the U.S., for example, very high allocations to technology, consumer discretionary, whereas Canada has much lower allocations. So you can see there that just investing in Canada and the U.S., for example, you're getting a much broader and diverse exposure to sectors more generally speaking.
Yeah.
Beyond that, I would say, the 60-40 is what we call a strategic asset allocation decision. What you want your portfolio to look like for the long term in accordance with your risk tolerance, your objectives and constraints.
Or close to.
Absolutely, and I think it's very important to not just have a strategic allocation, but have a tactical asset allocation as well.
Sure.
And our tactical program internally here at Lewisburg for a lot of our key accounts, we use, we'll opportunistically increase or decrease exposure within various asset classes. So this year at various points, we've seen opportunities where we could either add a little bit of exposure to equities, as we did back in the very trough of the market back in March, or as equities became a little bit overextended, we brought that more into a market weight type mix for equities. So I think that the tactical part of asset allocation has become even more critical as the proposition of 60-40 and strategic asset allocation on its own has changed, right?
Yeah.
So beyond that, I think that's very critical to understand, and I think in the institutional space specifically, we'd like to say that you can just make add some exotic asset classes to your portfolio and just fix things overnight.
Quick fix, patch things over.
And ideally, that would be the way things work, but it's generally that relationship, that age-old relationship that to generate more return, you need to take on more investment risk. That is generally true.
That holds true. Yeah.
So you can change that and fight that a little bit, but that's generally true. So in the foundation and endowment world, for example, we've seen spending rates historically at, let's call it 5%, and in an environment where bond yields are 4 to 5% and equities are returning a steady 9 to 11% per year, I mean, that's a reasonable spending target. And you had a lot of success in meeting that spending target.
Yeah.
But in the current environment, with a 40% allocation to bonds, which are yielding 1%, maybe slightly north of 1% on the core bond exposure.
Before fees.
Yeah, before fees. That's exactly right. Does that mix still make sense? And we think, depending on the risk tolerance and appetite of that institution, you may want to move to a slightly higher mix. It does depend, though.
I think you're absolutely right. I think it's a good starting point for a conversation about risk reward, right? And I think there's also another point worth making that, to your point earlier about risk, there is liquidity risk, and a 60-40 portfolio is a little bit more easily managed because the underlying assets are usually more liquid, easier to manage for the portfolio manager. So there are advantages within the 60-40 portfolio that you can't really ignore.
Yeah, I think that's a really important point as well, is that in the public markets, and we're talking generally about public market asset classes here, equities and fixed income, your liquidity risk, generally speaking, is pretty low. In most environments, you're able to liquidate these assets on a fairly expedited basis.
In and out if you need to.
Yeah, absolutely. And that, as you move outside of traditional asset classes into alternatives, and I think we should talk about alternatives because that's been pitched as the solution to the 60-40 conundrum.
It's a savior.
Right? And I think it's important. I think it's important to have that discussion that alternatives, you can add asset classes. And when we say alternatives, we mean real estate, private equity, hedge funds, and infrastructure, and some others. Yes, they can add some potential return to a portfolio and maybe slightly less correlation than public markets.
Yeah, that's all fair.
But I mean, at that, to add those asset classes to a portfolio, generally speaking, you're talking significantly higher fees, giving up substantial amounts of liquidity, and adding a ton of complexity to your portfolio. So there is a case for it, but it needs to be looked at very hard, and it needs to be used only in the right context. So I think those are the general takeaways with respect to the new 60-40 portfolio.
Yeah. Awesome. Well, thank you very much for your time. I think that was tremendously valuable. So until next time, cheers, guys.
Thank you.